Good morning, good afternoon, and good evening to all of you, and welcome to our Corporate Finance Forum, where we'll be exploring how banks and corporates are navigating the financing of supply chains in a rapidly digitizing world. My name is Shona Tatchell, and I'm responsible for business development for Coalition Greenwich's EMEA banking division. And before we begin, there's just a few housekeeping items that I need to run through with all of you. So first of all, when you joined this session, the system automatically put you on mute and turned off your webcam. So you're in a view-only, listen-only mode. During the session, we'll have Q&A where attendees can submit questions at the bottom of the screen for the panelists. You can submit all of these questions anonymously. If you're having any technical issues, you can use raise your hand and we'll do our best to assist via the chat function. And then finally, if you've joined on the computer and you prefer to use telephone audio, click on the arrow next to the microphone and then click on switch to phone audio. When you're using the dial-in information, make sure to enter your participant ID to join your audio to the video on the meeting. Before we begin, I'm just going to give a few words about Coalition Greenwich. We are the world's leading provider of trusted and independent insights, benchmarking and analysis for our clients. We work with a wide range of financial services clients across multiple geographies, securely sourcing quantitative and qualitative performance data, indicators, and insights from corporates and FIs, which we then analyze and play back to our clients. This gives them visibility over the current performance of their competitors, how they benchmark to the market, and major trends and opportunities in client spend and intentions, all of which helps our clients to make the right decisions to best steer their business strategy. Digitalization of trade is, without a doubt, one of the most powerful change factors in global trade. And we've been tracking and benchmarking its evolution for many years, working with global leaders in the industry. We source confidential feedback from both our clients and the corporates that they serve to help us in this benchmarking process. I'd like to take this opportunity to thank all of those who've already provided us with their views over the years and would like to invite other corporates out there to join this process. I'm delighted now to introduce our fantastic panel of speakers, drawn from some of these leaders in the world of supply chain finance, to discuss this important topic of digitalization and to share with us their journey and their strategies in navigating this world of digital trade. I'm first going to introduce David Smith, the General Manager of Cocoa Treasury at Olam Food Ingredients, who's joining us here from London or Dubai. What could be one of either. Natasha Condon, who is the Global Head of Trade Sales and EMEA Head of Trade at JP Morgan, and she is here in London. Irfan Butt, who's the Global Head of Supply Chain Finance at Standard Chartered and who stayed up very late this evening, joining us from Singapore. And finally, last but not least, my colleague Tobias Miarka, who is the Head of Corporate Banking here at Coalition Greenwich.
Thank you very much, Shona, and thanks everyone for joining. Maybe to set us off, I'm sharing here some recent findings on the buying behavior when talking to large corporates that have at least 500 million euro in turnover across Europe. So this is an ongoing study. It's preliminary data, and it's very exciting to, I think, share this hot off the press. And I think some of the key observations, which hopefully will set up this exciting discussion, is the following. I think, first of all, we see that the top 3 selection criteria continue to be competitive pricing. So competitive pricing doesn't go away. existing relationships and ancillary products, and also obviously whether or not the banks they are choosing has a strong international network. I think another really interesting takeaway here is to look at which parameters have received the biggest increase in terms of importance. And as you can see here, quality of digital platform solutions is the #1 point on this one, and which underlines also the importance of what we are going to discuss today. And then this is followed by solutioning, structuring and capabilities. So if you condense this and synthesize, I think it does underline, and I'm shifting now to the right-hand side of this slide, what the bank's expected role is, and it's threefold. One is access to capital. So it's really important that every part of the supply chain, every part of the chain is robust and supported by effective financing, especially in the context, obviously now of changing interest rates, high levels of inflation, etc. And effective financing also leads into the second point, which is smart planning. So we are really dealing, and I hate saying this, we're doing this every year, but we're dealing with exceptional headwinds, and they have not been going away. If anything, they have been increasing. We're still kind of at the tail end of the pandemic. We have uncertainties by Russia's invasion of Ukraine. And we mentioned already the impact of inflation, interest rates, etc. And then also there's additional reporting requirements coming up with regards to ESG goals, for example. So smart planning, really important to manage these times. And then obviously corporate clients are looking for seamless execution. So seamless execution means be error-free, be swift, but also show some level of resilience in the capabilities that the banks offer. So I think that's just to reflect a little bit on the feedback from corporates as we are talking to hundreds of corporates across Europe. What we've done also, maybe just to visualize a little bit, is to reiterate the importance of access to capital, smart planning, and seamless execution, is that we've drawn up here where these elements sit within the transaction flow, and to underline the somewhat limited but ever so important opportunities banks have to make changes in the overall transaction flow. So I think we're going to discuss those elements, and I'm looking forward to do this now with the panel. Just one further point, though, which we'll want to touch upon, I'd like to share, is the evolution of the use of proprietary platforms, so proprietary platforms by the banks, and also third-party platforms. And I think on this slide, maybe just 2 or 3 key takeaways. The first one is obviously, as you can see at the top of the slide, the strong dominance of proprietary platforms. So therefore the importance, and also the point that corporates are relying heavily on these bank platforms. Second point is that third-party platforms are catching up, especially I would say in Asia and also in Europe and in the United States. In Asia and Europe in particular, I think we can also see, though, that this is not an either or, but it is more a shared usage of both those alternatives. So they go along with each other. And the last point on this slide is to underline the increase in the usage. So as you can see at the bottom of this slide, so the increase of usage of proprietary platforms. So once you are on a proprietary platform, that the usage to set up and initiate transactions, etc., is really, especially in Asia and Europe, as you can see here, really tremendously increasing. This is just a change from one year to the next. So think, quite a remarkable change, and it shows also that clients are really now ready to use and digitize and use these platforms. Last not least, we would like to reflect on some of the pain points that clients are telling us that they are dealing with. And so what we see here is that there is actually, if you look through the verbatim from these hundreds of interviews we do, there are three key pain points. One is outdated systems leading to manual processes. Manual processing then leading to errors and inefficiency. And that alone just shows that the importance of moving to a digital and ideally fully digital capability is really important, because you can kind of exclude then those challenges. And the third point is that we do pick up and that the innovation promises made also by some of the banks are not always met quick enough. I think it always takes two to tango. So it may also be that sometimes the adoption of corporates is not as quick as banks would like to have it, and we'll hopefully hear about that as well. But I think the previous slide shows that the adoption is now really accelerating, and so people are looking out for this. So with this as background, and I think being so fortunate to have David here, who is not only representing kind of the buyer side, but equally the supplier side. David, if you want to start kind of sharing what adjustments you've been implementing in your digital infrastructure, and which are the most and the least successful strategies you have been following.
Hello. Thank you very much, Toby. Thanks for the lead in. Okay, so look, the shift model we've just seen does ring very, very true for us. Look, manual processes are alive and kicking, and they've scared the bejeebies out of me, right? So you know, the risk of error, the risk of duplication, because you have two parallel payment processes. You have your cash process and you have your SCF process. They're really scary. Now, touch wood, you know, we don't have any issues or errors. It's the risk of error for us. But what that does lead to is an extremely large level of inefficiency through you know, endless reconciliations and control processes of our you know, the manual nature in which we're doing things. We've embarked over the last 3 or 4 years on an SAP journey, an ERP journey to create a digital backbone. And you know, for us, the really key thing, and the thing that we're looking at more than anything from a customer perspective, is moving to host, you know, and making sure that we've got the right banking partners to allow us to move our payment processing into a host-to-host environment, so that we can bring in all of our ERP controls and make sure that as a customer, we're as controlled and as stable and as safe as we can possibly be. So for us, you know, that's our biggest challenge right now, and probably our biggest risk point is a very transactional one. I would say, obviously, price is important. We touched on that earlier. You know, very important. But the risk of error for me, and the reputational risk that comes with that, is probably the most salient and important thing right now from a customer perspective. And I think a lot of focus goes on the customer side with SCF, but and thanks for Toby for you know, really mentioning that I sit on both sides of the trade, because I feel the real pain areas within SCF right now are more for suppliers. The last year we've seen changes in interest rates like we've not seen in my adult life, and these are you know, a real learning for I think for all of us. And these changing interest rates have affected the way that we price our contracts. Markups are now very difficult to get right. For the past decade, we've been able to pretty much sleepwalk into getting the right markup within these SCF programs. The world's changed now. We're sat in a place where you can do a contract and 6 months later the interest rate's very, very different. And these are things that, as a supplier, are a very real pain point. It's not being addressed at the moment. We can do things to mitigate that process, and I think one of the things would be, or is, making sure that our sales team have fresh pricing, and that we're trying to use the best and most current rates we can, that we're anticipating where rates are going. We need to spend more time looking at our suppliers to ensure that they're uploading against the correct rates, and we need to make sure that they're paying at the right time. Now, these aren't necessarily, well, I guess they can be. So these are areas that corporates really need to get a grip on, not necessarily something that the banking community can necessarily help with, short of giving us an insurance policy that allows us to have stable interest rates. We've spent a lot of time actually building in-house tools using Power BI to make sure that we can monitor and control the payments and the debtors coming through. Again, probably the biggest pain point that we have is that our ERP system simply isn't fit for purpose, right? It tells you that you have a debtor due in 180 days, which actually should be due in 10 days. So, building tools like this in-house are absolutely vital to be able to control your process. But there are other things that I think that I've gone off piece, but we'll go back to where the banking community can really help us, I think. The other area where we have problems is where we have reconciliations of incoming funds. We see funds coming in, we can't necessarily allocate them very quickly or very easily. System and digitization should allow us to be able to allocate those on a much easier straight through process basis, and that's something that we're seeing coming through from our banking partners, and it's something that we're very keen and actively trying to work and make sure that we get into our systems, because it's a day of value chain that can be removed from the working capital cycle. With that, I'll hand over because I think I've probably waffled a bit too long. But
no, thank you. So because I think we want to represent here the corporate client view, and we know that our panelists from the bank side, they're very client centric. So it's really important to understand that. But I think maybe turning now to Natasha and Irfan, I think just with what David just said, and also further in the context of digitization with these three big elements that we've discussed earlier in mind, how is your institution adopting to fulfill these three key roles expected from banks? So, securing access to capital, helping on the smart planning and enabling smart planning, because obviously what David just said, making it easier and more secure, and then also the seamless execution with all the reputational risk if it doesn't go smoothly, etc. So over to you, maybe Natasha, if you want to start.
Sure. And I'll try not to go on for too long, because frankly I could respond to what David just said for the rest of this session. I promise I'm not going to do that. But I think he hit a lot of very important points there. I'll see if I can theme them around your key points here. But just to talk to access to capital for a second, and this is less of a digitization point and more, look what's happening outside. I was interested to see, I'm not surprised, but interested to see how the competitive pricing still remains at the very top of the list for the clients, the corporates that you've surveyed. I just wanted to kind of point out for anyone who's sort of thinking about that right now, that if you are an SME in an emerging market who has signed up to a supply chain finance program, and you're getting this fantastic margin that's based on the borrowing cost of your large, powerful customer like Olam, who can command, you know, really good pricing from their banks, and you're doing that in dollars. And let's give an example. You're getting discounted at SOFR plus 1%. Right now, 80% of what you are paying in fees is the base rate. The margin is almost trivial in comparison. I don't mean to say that as sort of special pleading coming from the bank, but there is, you know, if we reduced our margins to zero, they would still be paying more than 5% for that borrowing. And we have seen, you know, there's obviously impact on the supplier base around the world. Supply chain finance at its core is a tool to give benefit to your suppliers. As a buyer, it's supposed to be beneficial. It's optional for the supplier. They're only going to use it if it's the most attractive source of funding that they have. And what alarms me slightly about the current situation is it probably is still the most attractive source of funding that they have, but it's still pretty expensive. And sometimes you see, for example, the very smallest of suppliers even choosing not to discount because the fees have just got too large for them. And actually at that point, they use the platforms more as a kind of cash forecasting tool, and hopefully we add some value that way. But I do think access to capital is a really important point, and it's only going to get more important in the next 12 months or so, unless a miracle happens in the global economy. A lot has been talked about, you know, multi-bank capabilities and multi-funder facilities. And, you know, if you are a large buyer and you're offering this to your small suppliers, you need to make sure you've got supply of credit that's not going to go anywhere during hard times, because those suppliers are depending on you. And that conversation has been a real driver of kind of where we've been seeking to innovate. We've got hundreds of banks who fund JP Morgan supply chain finance programs to kind of provide that capability. Just briefly on a couple of the other points, and then I'll let Irfan get a word in. But I did want to talk about, on the smart planning point, I think I mentioned a second ago, cash forecasting. Because this is something particularly for the suppliers, also for buyers, because obviously buyers want to know, to David's point, when the money's coming out of their account. But for a lot of smaller suppliers, you know, they may not have the luxury of a big ERP. Some of them don't have ERPs at all. They have a spreadsheet where they try to track when payments from their big customers are going to come in. And so our platform, you know, having a platform effectively that tells you when you are going to get paid and gives you that transparency and complete predictability is, they tell me, very important. I do also want to point out that it makes the buyer's invoice acceptance time very transparent to those suppliers, right? Because once the buyer accepts an invoice, we're going to fund that supplier immediately if they're on auto discount, which the vast majority of them are. And so sometimes the manual processes that David is talking about, you know, you find out that even incredibly large and sophisticated corporates maybe take quite a while to accept an invoice because it's never mattered before that they need to get that done fast. And then last point I did want to just briefly cover on seamless execution was around onboarding of suppliers, because this is incredibly important. At the end of the day, you know, the suppliers who need supply chain finance the most don't have in-house lawyers necessarily. You know, they don't have sort of big corporate infrastructure to help them to kind of get on board. And it's incredibly important that when you're onboarding, you offer them something that's, you know, relatively straightforward, right? You want to ask them quickly to give their details. You want to use public data to do KYC information. You don't want to ask them the same questions over and over again. And I think that has developed, that's come a long way in the market. Onboarding capabilities generally are enormously better, I think, across the top of the supply chain finance market than they were a few years ago. But fundamentally, you know, the tool at its best should be straight through processing to me. There should be no manual process in supply chain finance. It should be automated on the buyer side, and on the supplier side, if they choose not to have it automated, that should be because they have a reason to, you know, they want to manually control what they do. The vast majority of suppliers on our programs are on auto discount. And I think all of our buyer programs are automated. So then the platform is important, but if you get the platform right, nobody actually has to use it. Sorry, Irfan, over to you.
Thanks, Natasha. Just to add to what you've already covered, I think to be a question initially in terms of how we adapt to these in the context of digitization. We look at digitization as an opportunity as well, right? And I don't think banks are that different to corporates. I mean, what digitization brings is scale, efficiency, visibility, right? Whether you're a corporate, you're a bank, you're exactly looking at that. And that's how we see digitization playing a role and continue to play a role in the supply chain finance space. Now, supply chain finance, and I picked up on something David said earlier regarding the parallel processes. I think that's a very interesting element to focus on, because supply chain finance is quite a unique offering that it touches both the trade finance and the cash offering as well. So whatever digital strategy or digital journey that we look to go on, it has to complement both the cash side and the trade side as well, because David, as a buyer in these programs, for him, it's just a cash payment, right? Whereas for his suppliers, it would be a financing arrangement that you put in place. So that element is also taken into account. And what we're looking at is through digitization. If you ask me 16, 17 years ago, you would have a product being developed and you'd have some patched up technology that you used to roll out that product. Now, actually, digitization is actually leading product development, and it's allowing banks like Standard Chartered to develop new solutions for our clients. Whether they're the buyers or the suppliers, we're already looking at, other transaction banking offerings that we can provide to our suppliers in these programs, whether it's an FX conversion. So we're also looking at deep financing as another example. We're actually looking at providing financing to multiple layers of suppliers. We have a transaction, we've done the 11th tier of suppliers financing through deep tier. So that's what digital and digitalization helps us in from bringing new solutions to our clients. With regards to these three topics around access to capital, adding to what Natasha said, I think, again, I talked about bringing scale to these programs as well. It allowed us, we currently have programs, we're talking about supplies in Vietnam, we're talking about supplies in Pakistan, Ghana, Guatemala. So you can talk about the scale and size of these programs that we can achieve through these digital solutions. It's also about bringing that supply chain resilience, that our corporates are looking at. That's very key to buyer in terms of having the resilience. And we talked about the challenges we've faced in the past few years, and that's very much the focus. And what these digital solutions allow is offer these programs to these suppliers, even in the current high interest rate environment. It may still be more beneficial for them than borrowing in the local currency. So that brings that level of resilience in the supply chain space. Smart planning is another area that we tend to focus as much as we can in terms of talking about invoice approval. That's another thing David mentioned, and Natasha touched upon that as well. One thing that we get asked from our corporate clients is there a cost to supply chain finance program? We keep on telling them there is no cost, but there's certainly a level of commitment that is required from corporates, right? And we're not just talking about the treasury team within the corporate organization. It has to come across all the different functions, whether it's procurement, finance, payables, payments, all of this. So that planning, that smart planning is, we look at it at that stage in terms of also advising our clients in terms of what would be the market practice, whether it's invoice approval. We also look at their current processes to see how they operate. If they have a credit notes arrangement, how do they operate that? We also come up with some solutions, digital solutions around the Netikoff engine, how we provide the information back to corporates. The third thing around seamless execution, not going to add much to what Natasha's already said in terms of the digital onboarding tool, but I think where we're also seeing value in digitization is in some markets. For example, you have a certain regulatory requirements or legal requirements, AR registration in China, for example. So that's where the digital solutions help us in bringing more efficiency to these processes, which indirectly helps the supply joining the program start trading.
Thank you. Thanks. And David, I don't know whether you have any reaction from this. Otherwise, I mean, in the interest of time, we can also roll on. But just wanted
to just the only one thing that I didn't mention that they both mentioned was around onboarding, and I would like to add that we see it's improving, and I know these two organisations are very good on that side. But supplier onboarding, supplier onboarding, the attrition rate is real, right? So and that's invariably down to onboarding processes, KYC, or a mixture of the two. So it's as important as anything else in the process, and the time, right? If you can take 6 months to onboard a customer, or you can take 6 days, depending on how smooth the process is. And that's a very real value driver for any organization.
Yeah. And actually, that's something we see in our research as well. I mean, over the last years, I mean, onboarding was clearly one of the main pain points. Yes, it has improved, and obviously it's even harder to improve on the trade finance side than maybe in some other areas like cash management, etc. But unfortunately, also the expectation level of the corporates have accelerated as well. So that's probably something to keep in mind. So as factually it has improved, expectations have increased as well. And if we see all these adoption levels, the digitalization adoption levels on the trade finance side increasing from the corporate side, I think that would only add to that increase of expectations. Thank you very much. So let's move maybe to the next question. I mean, we did just in the intro look a little bit what's the evolution around third-party providers versus the proprietary platform. So in the past, banks often regarded third-party providers as potential threats. I think we now see that in the current landscape, it shows that banks are forming closer collaboration with these providers. Also, I think that, by the way, the funding of those third-party providers might also have changed with the interest rate environment. So obviously, there's also some risk. We've seen some of these third parties actually closing down as well. So before you invest as a corporate to adopt into something, you really want to make sure that it stays because there's obviously costs around. So could maybe back to Irfan, to you, could you share some of your perspectives on this evolving dynamic of collaborating more, and also maybe whether it's forced or not, and how the adoption level of corporates that you see is changing?
Yeah, no, Toby, for us it's quite simple. We're looking for the best solution for our clients, right? At the end of the day, I always say, I mean, clients are not interested in products, they're looking at solutions, right? They have a problem, they're looking for a solution, and the solution can be delivered through either one product or one platform, or it can be a combination of different things. You touch upon in your previous slides the whole flow, right? I mean, as Standard Chartered Bank, we have announced a few collaborations with the parties as well. So we're quite open to collaborating with third-party providers. But the key element is we identify the right providers. We need to understand what the role of the third-party platform is in these solutions. We also look at how they bring operational efficiencies to our processes as well. And also, in terms of the overall value proposition for the client, we've had various conversations with clients. We already are working with a third-party provider, and they're quite comfortable there, and they want seamless integration. They don't want to make significant changes to their process. So in Standard Chartered, we're quite open to that as well. But I think one thing worth highlighting here is also we need to also take into account the regulatory landscape. We've seen in a good few markets where there are regulatory requirements, for example, around data hosting in China, India, and these other markets. So we also have to take that into account as well. Okay, while client may be very interested in working with one platform provider in Europe, and they want to replicate the same in other markets as well, it may not be possible. So we look at the combination of all these three. But at the end of the day, we're here to service clients. We look for the best possible solution for them.
Right. Natasha, your take?
Yeah, no, I agree with that. I think the question is a slightly 2010s question, if you see what I mean, when there was for a while a kind of a little bit of a war in the market between the banks and the fintechs. And that, I think those days are mostly past. I think you made a good point in your intro to this question, but to say that, there's been a bit of a clear out in this market. Running a world-class supply chain finance platform is expensive. To Irfan's point, you have to comply with a lot of regulations in a lot of markets to provide something that will work effectively to a modern multinational. You've got to be able to manage the tax reporting in Poland. You've got to be able to manage the invoice registration in Colombia. You've got to be able to handle all of these things. And so what has happened is a lot of smaller providers, both banks and fintechs, have dropped out because it's not cost effective for them to operate. And what you are left with is this landscape of a few of the larger banks with proprietary platforms and a few really high quality fintechs. who are pretty willing to collaborate with each other, I think, nowadays to find the right opportunity. And I have, just like Irfan, I pick the solution that works best for the client, and I have the luxury of being able to do that. I have a proprietary platform that I think is pretty good. I have a big partnership with Taulia. I have a partnership with Climb, which is a Latin American specific fintech. And all of those solutions are good for different client requirements. I will say that one of the developments on the bank side that has helped us to get to that point, I think, has been the standardization of multi-bank facilities across the board. Not many clients, in my experience nowadays, want to have a supply chain finance program funded just by us. Not that we wouldn't appreciate it, but most people want to know that they have multiple funding sources. And in an environment where everyone is a little bit nervous about the credit constraints and the base rates and the situation that's happening outside, I think also not many clients want to just lose control of the funding of their program and let a fintech go out to any old investor and bring in whoever happens to stop by, and they may run out of appetite in 6 months or 12 months or who knows. So what you're ending up with is everybody who runs a supply chain finance platform needs to be able to offer multi-bank capability. But at the same time, big corporates who are buyers on these programs, they want to have control over that. They want to choose who are the banks who are funding their facilities. They want to feel like they've got relationship banks in there who have skin in the game and will not run away when the economy turns against them. And I do think that across fintechs and banks, the solutions at the top of the market provide that now. But that is a conversation I've had more, I think, in the last 6 months than I had in the prior 5 years. People are worried about the sustainability of these programs. They're worried about making sure their suppliers have access to credit even when it's tough outside. And so I think a lot of this conversation between banks and fintechs is coming down to that point right now.
Yeah, and I think that reiterates also, this access to capital is really, it always was key, but now with the interest rate environment obviously changing, it is even more important. So I think some of the other, and if you think about functionalities and also just capabilities, it has been pushed down in the priority a little bit, because essentially you go with the partner that makes that first point, which is securing access to capital, and not only for yourself, but looking after the chain, right? So that, because the weakest part of the chain is what will drive the overall chain, right? So you have to make sure that you have partners that might not be as techy, but are actually first putting in that security and that access. I think that's even more paramount than before. That being said, we are seeing obviously that banks really have a long agenda of digital priorities. So here, we just wanted to share here what we are picking up when talking to our clients, the banks, in terms of what they are working on. So, self-service functionalities, improving platform design. That's it's kind of painting a bridge type of exercise where you will never be done with that one. Forecasting we talked about already, because of the importance of smart planning, etc. And then also things that I think we see, especially in the United States, is mobile applications. I think it's not as widely kind of used in Europe, for example, but we do see that picking up in the US quite big time, and so I think that's exciting. At the same time, we can't get away with the AI hype that's been discussed. To what degree can banks combine intelligent automation and make that accessible for clients, etc. General AI, generative AI, etc. But David, now looking at all these digital priorities that banks have you actually adopted, or will you adopt any of those cutting-edge digital solutions offered by banks, either those currently available or those expected to be rolled out in the future? Because I think it's quite a serious question, because having talked to some of the digital drivers within banks, so the leaders there is also some frustration sometimes that banks build really interesting and quite nimble digital capabilities, but the adoption might not always be, you know, at what they would expect it. So I think it would be good to hear from corporates like you, what you have been adopting or what you are willing and looking forward to adopt in the future.
Yeah, I mean, look, we see lots of bells and whistles on a lot of programs, and some of them we use, a lot of them, most of them we don't. That said, that doesn't mean that other clients aren't using them, you know, to a lesser or greater extent, and they're not important to other people. So, you know, we're very aware that, you know, what suits us doesn't necessarily suit everyone else. But what I would say is there's probably 3 key areas where we are, you know, very focused on where we think cutting edge solutions, you know, offered by the banks or hopefully offered by the banks are really going to impact what we're doing. One of the things that Natasha said, just not just now, but in her original, her first speech was around, you know, automation and straight through processing, and you know, I'm fortunate, as Toby said, to be on both sides of the trade here, right? So, you know, one of the things that we see is that, you know, the dream that's sold is that you get paid within 2 to 10 days. The reality is sometimes that's 30, 40, 50, 60, 100 days, depending on the location and who the customer is. And we see what we, you know, in my industry, I've got a number of cocoa firms, I won't name them, but we see varying degrees of capability between them in the same origins or locations. So we can benchmark and we can see performance. And that, now, the same is true of my suppliers, right? They're looking at me and they'll be comparing me to Cargill, to Barry Callebaut, who are you know, my opposite numbers in the same space. And you know, one of the things that they'll be doing when they're pricing markups is they'll be looking at a weighted average pricing. You know, there's 180 days, 120 days, 100 days, whatever the extended payment terms are. And they're looking at that and they're saying, we get paid within 10 days, or actually it takes us 50 days to get paid. So the blended markup that we're going to do is 50% our own pricing, 50% the pricing from the SCF program. Now, obviously, everybody wants the SCF pricing to be, you know, the full markup. Now, going to Natasha's point, the automation allows that to happen and allows it to happen very quickly, and those payments to be released quicker. That translates into better pricing for me, right? So you know, that's absolutely vital. And you know, we want to be seen to be the best in class at what we're doing, and I think anybody would want to, right? Because it's, you know, the sooner you get that payment released to the SCF program, it's just better for everybody. So host to host is really key. It helps with supplier stickiness because they're happy if they're getting paid and they can benchmark you and see that you're better than your competition. To Irfan's point, it's really complicated. He made a really great point just now that you know, it's not just the treasurer, it's the guys in logistics, it's the guys on the sales team, it's you know, it goes throughout the company, and also the same's true on the banking side. And what we see from a better banks, sorry, I know there's fintechs as well, but from my perspective, the banks is the really good banks are able to give you a when you're implementing a program or going live, they'll give you a crash team of subject matter experts that are going to come in, parachute in, and allow that program to happen quickly. And there's real value in that. So choosing the right banking partners, again, I can't remember who mentioned, I think it was you, Toby, about stable banks, ones that are you know, not going to disappear. Actually, it was Natasha mentioned that we've seen some consolidation and some people exit the industry. You know, having that level of stability is really important. It allows, you know, the partner we choose reflects on us as a corporate, and so it's our reputation that we're putting in the hands of our banking partners. So it is or financing partners. So it's really important. So that's the first thing, the host to host. The second thing, and I'll touch on this very briefly because I'm running out of time. Look, one of the things that we know from the rating agencies and the auditors with disclosures coming or not necessarily needing to be the case is you know, we need to have access to transparency to see who the underlying financiers are. The more underlying financiers within a program, the better, right? Because it shows you've got a much more stable and larger funding base. The regulators and auditors like that. So again, that's something that I'd like to be able to see is within portals, not necessarily for everyone to see, but you know, to be able to see that level of composition of your funding, I think is important. And I suspect that the rating agencies and auditors are going to be asking for that. So easy access to that, I think, is going to become more important. Now, the third, and I've saved the best till last, and I think this is the most important thing from my perspective in terms of digitization, is ESG, right? I think that SCF programs are in a really unique place right now because we can control or certainly affect pricing on SCF programs based on ESG components, and that you know, these tools suddenly become incredibly powerful virtue-based tools for you know, hitting you know, helping us all on this net zero journey and helping us with, well, the E, but actually not just the E, the S and the G can also come into that. You know, one of the things that we're working on as a corporate at the moment, along with, and I can't talk too much about it because there's a big announcement coming, but between OFI, Cargill, ADM and Louis Dreyfus, we'll shortly be introducing an absolutely game-changing, granular level, farmer level, invoice level ESG tool that will provide all manner of information. We're doing it anyway, right? It has to be done because our customers require it, but actually having that level of digitization tying into these SCF programs will be an absolute game changer. And you know, when you see these industry-wide level programs coming in, being able to plug into the digital footprint, having partner banks allowing APIs into these tools, I think is going to be really the next big thing for SCF.
I think it's great to hear that. I mean, it's not only the banks trying to digitize the supply chain, but you know, leaders like yourself also contributing to the functionalities and capabilities, because some of these things can only be done by, you know, the big leaders of a certain industry, for example, going together. It can't be actually necessarily led by banks. And so I think that's great to hear. And thanks for sharing that exclusively free announcement. And we'll be watching the space. Yeah, I think that's good. Really exciting. And I just also wanted to reiterate your earlier point on the implementation. I think that's what we've been hearing and discussing with many banks, including JP Morgan, Standard Chartered, but many others as well, that having those teams, and it's a scarce commodity. It's really tough to commit to that as a bank, right? Because you're not an IT specialist, and it's not really in a way your job. But those top banks do understand that the adoption level and this whole digitization has to be done with a high touch part of it to make sure it really is fit for purpose, and it's not just a shiny toy that is then, you know, at some point sitting in the corner. So I think that this high tech combined with high touch is a really recurring theme that we cannot underline enough to make things really work and have the adoption level that both sides, the corporates, but also the banks obviously really would like to see. Before we go to the kind of next question, and I do want to go then look a little bit into the future, but maybe Irfan and Natasha, any further reactions to what David just mentioned?
Only one from me, which is that his first example made my eyes water. Where you have a situation like that, where he talked about the payment taking months to get to him because the invoice hadn't been accepted, that is actually a digitization problem, right? That is a data problem on the buyer side. It's just not the supply chain finance platform that's the problem, right? That buyer, that customer, wherever they are, they need a really good e-invoicing platform. That's what they need. Or, to his point, we've sent teams in to work with the procurement group at clients who signed up for these programs to get their invoice acceptance time down. And although I don't want to jump on the AI hype train, but I do actually think that some stuff like invoicing, there is obvious opportunity for AI to improve the efficiency of some of those background processes. And that can only help because, my platform can pay a supplier the same day once the invoice gets accepted. But if it's not getting accepted for 2 months, then you do not have a straight through process.
Right. Great. But anything from you, Irfan? Otherwise, we would go to the next question, but go ahead.
No, so we just, it's echoing what Natasha said, I think in terms of, we talk about third-party platforms. We think we'd only talk about SCF platform providers, but it can be other platform providers like the e-invoicing players or e-procurement and stuff. So I think there's a role to be played by all these different providers in a very efficient solution.
Yeah, thanks. Now, in the interest of time, and we do want to keep a few minutes also for questions at the end, but I do want to kind of close our part with looking a little bit into the crystal ball. And I know, Natasha and Irfan in particular, I know that, innovation is really very close to your heart, and you're working at banks that are known for driving significant supply chain innovation. So what is your outlook in the future of supply chain digital solutions? I know the big themes that you see, and what is, how realistic are some of these? Because I think there's a lot of kind of lofty ideas, but I think corporates want to look more of what is really real and can be achieved.
So shall I start? I'll give you two, one depressing one and one optimistic one. So the depressing one is the short-term answer, which is as long as the current economic conditions continue, we are going to see a bit of a back to basics move in all things supply chain finance, and that includes traditional trade finance as well as supply chain finance, letters of credit, bills of exchange, everything. The supply chain is under stress. The smaller parties in that supply chain are under more stress than the bigger ones. They are going to need this financing more and more, and therefore what corporates need right now is not to play down the technology, because that's extremely important, but what corporates want and need right now, in my experience, is not the bells and whistles. What they want is an immediate hit of working capital into their supply chain as fast and as smooth as possible. And so where the digital innovation there really matters is in things like onboarding that create barriers to entry if you don't do them well. And I think there are just a lot of programs launching right now where the feedback from the corporate was, I need X 100 million of working capital. I have 20 suppliers. I'm really worried about their stability, and I need it up and running by the end of the year. Go. That's the challenge that we see right now. And we'll be ready for it, but it's not a shiny, exciting technology conversation. The more optimistic longer term view is this. I love the traceability program that David just talked about. I think is awesome. I already run several ESG supply chain finance programs where I have an API built into the platform directly from EcoVadis, in fact, which is one of the eco auditors. We have multiple others that we work with, and they give a view on what the supplier is doing. It goes straight into the platform. It affects the funding incentive today. And when those systems start to interoperate with the financing platforms, to David's point, it just makes enormous flexibility, optionality. You can do all kinds of exciting things with that. You can incentivize almost any behavior with a financing price. So if you want to get your supply chain to cut their carbon emissions, you want them to meet social goals locally, you want them to sign up with the auditor in the first place, this is how you can incentivize them to do it. And I'm very excited about that. So a lot has been talked about in trade digitization around the magic word interoperability. But I think here we see a place where it is actually going to happen, and it's going to happen It's already happening. So you can see it's not going to take too long.
Thanks for also giving some optimistic outlook. We all need that, I think. Irfan?
Yeah, I'll continue on that optimistic trend as well. I think just as Natasha mentioned, I think I'll just say collaboration. Toby, I know you had one previous question around collaboration between banks and platform providers. I think you probably see more collaboration within the banking sector as well, right? How banks participation as a program, there is an opportunity there through the digital solutions. David talked about the composition of funding, right? In terms of as a corporate hub, what visibility they can get in terms of the funding, which banks are funding. So I think there'll be more collaboration, not just with the fintechs or the third-party platforms, it's between banks as well and with corporates as well, right? I mean, David shared the exciting news about the traceability platform that they have and stuff. So it's also about extracting value out of those tools that the corporates are using and using that data to further enhance the solution. The second thing I would say is the sustainability bit that's been touched upon by both the other participants. We're seeing that more and more becoming a very important topic of conversation with clients. I give this example. I mean, 6 years ago, that used to be the sustainability or ESG used to be the last page on a client presentation. It's coming to the middle of the deck. And it's not going to be long before it's one of the first items on the agenda with regards to corporates. So we'll see more and more collaboration and digital solutions being used to bring the ESG angle and the supply chain finance angle.
Thanks. So in the interest of time, I mean, we did receive a couple of questions. And by the way, all of those questions we cannot answer today because we are limited in time. We will be happy to follow up with if you are not anonymous. Otherwise, obviously, it will be a little bit more difficult. I think one question which I think is quite interesting is here. One of the attendees says, you mentioned at the beginning that corporates can join this study. How can we participate? That's always a question we love to hear. So as a follow-up, I mean, we'll send out the deck anyway to all the people who have signed up, and we will also send you a link to how you can participate and contribute to the community, so to speak, and help banks improve, and so that you get better offers of and that they are really targeted in what they're offering. So that's a great question.
And then there was another question that I think has already been partly answered, but feel free, the person who submitted to challenge me on that. But the question was regarding platform quality and capabilities, aligned with the evidence that we have that there's an increasing use of third-party platforms, particularly in the US. And I think this question is really sort of directed probably more at David, which is, what would corporates' main drivers be in accepting that additional risk of working with a fintech rather than their own bank's proprietary platform to manage supply chain finance programs?
Look, it's different from company to company. When you're a company like mine, your relationship banks and dealing with those relationship banks is paramount to the running of your business, and particularly if the banks are offering safe and stable programs. In terms of dealing with fintechs, I'm going to be a bit controversial here. I don't see any problem with dealing with fintechs. I think a lot of the innovation comes from them. My driver at the moment is more around moving away from actual portals and functionality and moving to host. So a lot of the really nice stuff really isn't so relevant to me or my organization, but for smaller SMEs, I think that there's certainly a market space and those functionalities where they're not looking to move into host-to-host environments. and their customers and their supplier. It's always the other way around, isn't it? In this, their supplier experience is important and shouldn't be underestimated. So I they have a place. I'm not sure I'm answering the question, but I think that's my view.
Thank you. That was a very comprehensive answer. Have I got time to squeeze in the one last question, Toby? Or
let's do that, but let's be very brief because I think we should honor everybody's time here.
So it's a question from Matthew Joseph. Are banks, so obviously this is directed at Irfan and Natasha, are banks looking to incorporate the ICC sustainability standards and trade finance standards when looking at supply chain finance programs and operations? Irfan, we'll go to you first, and then Natasha.
Yeah, the short answer is yes. And I think this just goes beyond just the trade finance, sustainability finance. It's also about the SCF standards that we've established, right? I mean, you see a lot of different flavors of SCF out there as well. But in terms of adhering to the standards, the ICC standards are very much something that we're looking to incorporate.
Great, thank you. Natasha.
Very, very quick comment on that, which is that I like the ICC sustainable trade standards very much. I think they are relatively broad as first drafted, and there's not a common understanding among the banks of how that gets practically implemented into a supply chain finance program right now. And in fact, this is, jumping on my soapbox for 20 seconds and no more, I promise. This is a general problem in the ESG space in trade everywhere, right? We don't have a common standard. There is no common definition of a green loan in trade, although there is an LMA green loan definition. There is no common standard for sustainable trade. So very happy the ICC is pushing us towards it. I think we still have some way to go. And in the meantime, my clients are applying 50 different standards. So my approach is very much, I'll take those and I will apply them, providing they meet JP Morgan standards for what counts as an ESG transaction, which means we have some fairly rigorous conditions that we apply. If you want to call a deal ESG, it has to be material, it has to actually make a difference, there has to be substance behind it. And we are not going to go near a structure that could be accused of being greenwash. So I guess I'll look at anybody's standards is the short answer for ESG, but they need to live up to the standards that JP Morgan sets.
Thank you. I was just, and just very quickly, Toby, I don't know whether you wanted to have a quick word on that last point of Natasha's.
I think what you just said, Natasha, is the problems of standards and aligning that, especially in the trade finance space, is something that we are currently actively discussing. So watch the space. We'll be hopefully be able to contribute to kind of a solution to that in the near future. So I'm very excited about that. But let's watch the space. I think we do are over time now. So I would really like to thank you for participating. Obviously, David, Natasha, Irfan, it was obviously a good panel. Lives by its panelists, and so I think we were fantastic panelists, very thoughtful and obviously really industry leading, which is what we're looking for to provide to the listeners. So thank you very much, and looking forward to following up on the questions that we've received. And we will provide you with the deck as well. So I think there was a lot more information than what we could discuss. And I think this will remain a very exciting space with a lot of changes. So I think, again, watch out the space for this. And thank you very much.
Thank you.